Hey, Jeremy Surier here. I'm excited to bring you an update to the Boston commercial real estate sales trends. This is the third quarter of 2024 market update. And so briefly, what we're going to cover here is the Rockingham, Essex, and Middlesex County markets north and west of Boston, comprised of all of the sales from $1 million to $100 million for retail, office, industrial, and flex assets. So we track this data going back to 2006, and what you'll see here over this time period is the long-term average of transactions. This is the number of buildings traded is 454 buildings per year out of those three counties. And what you'll see in 2024 is a deceleration in the market. We're currently, as of the recording of this video, at 341 transactions for the year. Annualizing that out to the end of the year, we're expecting to end the year around 391 sales. You can see that this is quite an adjustment off of the 2021 and 2022 numbers, and it is a trend below the long-term average, which is really indicative of the fact that the interest rates in the market have definitely had an impact on decelerating the market velocity. So as we look at the Fed rate adjustments on a monthly basis going back to 2021, each of these columns that you see on your screen represent the number of transactions by month per year for that market area. And what you can see here is the gradual trend over time of the deceleration that's happening. And what I did here was I marked off the Federal Reserve interest rate changes. And you can see here that as they've raised those rates, they ran up through 2022 into 2023. And then as we came into the second half of 2023 after July, they paused and held the rates until we got to September of 2024, where they made their first rate cut of 50 basis points and then another in October of 25 basis points. It is too soon to see that show up in market velocity. But what's surprising here is that we're expecting to see this happen more quickly. The good news I would say is that our year-over-year sales data for the time period that we track, we're now at a 20% fewer transaction volume than last year. Earlier this year, it was much steeper than that. So we're starting to see the market. It looks like it's starting to stabilize or normalize. It's certainly not an average market at this point, but we are starting to see some stabilization happen. Now, it's common to think that as soon as the rates get cut by the Federal Reserve, that you would immediately see those savings show up at the lending, in the lending environment, in the debt markets. That's not necessarily the case this time. So what we're seeing right now with the 10-year Treasury is that it's actually, it dropped down to about 3.6% this year, but it's now in the end of the third quarter here trading at about 4.4%. So why is that happening, and how does that affect lending rates? Well, basically what happens is as the Federal Reserve has cut their federal funds rates, they're down at about 4.5% right now. We've actually seen the 10-year Treasury migrate up, so yields have increased on the 10-year Treasury. So this is an indicator of the risk-free rate in the market, and as this rate comes up, it actually becomes more expensive to borrow money for commercial real estate in general, and the 10-year Treasury offers investors an investment opportunity to move their capital into that doesn't really have, it does have upside because the rates are more likely to come down on the 10-year than go up, which will create value for the investors. But it also gives investors an opportunity to say, well, if I can get 4.4% on my money, why would I go buy a piece of commercial real estate at, say, 6 or 7%? That risk premium over the 10-year may not be high enough when we see this kind of pressure coming from the floor, I would say from the bond market. So why is the bond market doing this when the Federal Reserve is supposed to be cutting rates, and we're all expecting to see rates come down, which should in fact it closes the bid-ask spread on pricing, and it drives market transaction volume. Well, basically, there are three reasons for this. The first is economic and inflation expectations in the market. Mainly, we have diminished recession fears. So back in the environment of August and September, where we were seeing the 10-year down to about 3.6%, the jobs reports were becoming problematic. And the Federal Reserve was saying that the labor market seemed to be decelerating, and that was becoming more of a concern for them to stem a recession than to focus on capping inflation and bringing it down. So they were shifting priorities in their discussions. Those fears have diminished since then, which has now led investors to believe that the Fed's going to actually slow down on their pace of rate cuts, which could lead to some persistent inflation in the economy. Another reason why the bond market is paying the yields that it is right now while the Fed's cutting is the concerns over U.S. debt growth and the necessity to bring higher rates into the capital markets to attract investors to buy U.S. bonds. So the primary concern here is really being driven by the election proposals from both the Democrats and the Republicans that we saw coming up to the election, both seeming to point to increasing deficits. And anytime you have increasing deficits, there's a necessity to raise more debt or issue more debt and then sell more bonds. And the last piece is really the concern over debt cycle risks. And is it possible in a rising debt service environment and a rising debt environment where the debt becomes unserviceable? So that becomes a higher risk asset to be invested in, and it just becomes a cyclical thing where the rate continues to go up to compensate for the risk on it. So there's some concerns right now in the markets that are holding rates where they are and rising, bringing rates up, despite the fact that the federal funds rates are coming down at the same time. So stay tuned. This basically is showing up in our market, and we're seeing right now a deceleration that's continuing on in the market, where we have year to date 341 transactions, about 1.269 billion in volume. On average, we see about 2.8 billion in volume. So what this says is that there are a number of smaller assets that are trading in the market. That we're not seeing the large asset volume in higher priced assets trading. We're also seeing a correction in the average price per square foot across the retail, office, and flex markets. The industrial market in 2023 went through a volume correction where we saw some weaker or more tertiary market assets trading that brought the average price per square foot down. We're seeing that now recover. So the industrial market is actually showing signs of, I would say, recovery from just the adjustment or the impact of the rates coming into the market. But the office market is still trending down. We're seeing average price per square foot pricing down around 2008, 2010 levels. The retail market seems to be pricing in the rates, and the flex market is starting to show signs of recovery from the biotech life science bubble that hit really, really hot and hard in 2021 and 2022. Also, what's interesting with the Green Street Commercial Property Price Index is we're seeing a trailing 3-month trend of 3% price growth nationally. They were indicating that we had kind of hit the bottom of the price adjustments nationally back in June, and we are now starting to stabilize. But what they're noting is the fact that the bond market has picked up the way it has, that's actually now leveling off our recovery in the commercial real estate market. And so what I'm expecting to see happen going forward is sentiment, as you see here, is off a little bit, but I'm expecting to see more concerns over less over pricing and interest rates. And I think we're turning the page and moving more into concerns over tenant durability and quality. And so I expect to see a lot of conversations in 2025 about the stability of the companies that are on the rent rolls for these assets that we're looking at, their ability to perform, their ability to pay rent, how strong their companies are. That's really going to become a key underwriting item in the 2025 market. So the retail market, let's take a closer look at what's happening here. Still cranking. Year to date, we've got 176 transactions. We're expecting that to end the year about 202 transactions. So you can see here that if we're going to see about a 391 transaction year, 202 of those transactions are coming out of the retail market. So a lot of volume in retail. Retail is doing really well. Still a very highly favored asset. And in fact, despite that the pricing is moderating somewhat on an average price per square foot basis, we are seeing that it is still very much a prime asset class in the greater Boston market. The industrial market, year to date, we're at 82 sales. We are expecting the year to end about 94 sales, so we're starting to see a somewhat of a pickup from the drop-off in 21 and 22. I think that we're seeing more capital start to come into the market here. There was a pullback as rates came up and a lot of money was sidelined, and I think it's selectively now starting to re-enter the market. Tenants are re-entering the market. The rents have adjusted somewhat in the market, and we're also seeing pricing expectations have settled in the market. So I think we're probably going to be stable here at this point in the industrial market. We may still see some price appreciation, but it's not going to be anything like what we saw from 2017 to 2021 in that run up. Where we were looking at 101 a foot all the way up to 183 a foot on average. So we're right now ending the year at about 181 a square foot at the end of the third quarter here, and I'm anticipating that to hold through the rest of the year in 2024. And in 2025, I expect industrial to stabilize and sort of level off on growth on pricing. And then here's the market cycle chart showing a forecast for the third quarter of 2025, where we actually see the industrial market starting to come over into the first stage of hypersupply out of the peak phase of the market. I actually think we're already here. This is a forecast, a year from now, but I think I'm already seeing these fundamentals in the market now, where we've started to see some vacancies last a bit longer. We're starting to see some rents soften a bit, and we do have deliveries hitting the market, and there are some assets that are sitting vacant that are brand new buildings that have not had any tenants absorb the space. So that's indicative of a phase of the hypersupply phase in the market. And then lastly, the office market, for volume, year to date, we're at 56 transactions. The office has kind of become like a toxic word in the market, but it's actually, I think probably a very prime opportunity to pick up this asset. If we look at the 2008 and 2009 numbers, look at 2010, where we had trough activity and volume and trough pricing. We're annualizing out in office to have 64 transactions this year. That's well below. That's even below 2010 levels. So if you're in office, I think the two stories to look at are these. Number one, the average price per square foot is soft, and that's really driven by perspective on the asset class, by lenders, appraisers, and by investors in general. But it's a tale of two markets. It's you've got you have a Class A urban office market that is strong. There's been a flight to quality in the market. The B and C assets are suffering, but then when you come into the suburbs, your suburban office park assets are definitely repricing. We just traded a 71,000 square foot asset at about it was like $77 a square foot to a user. So there's certainly some buy opportunities, and there are buyers for these assets in the market. However, if you're in smaller multi-tenant office product, particularly in the suburbs, we've actually seen higher demand for those assets We've seen rent growth in those assets, and we've seen appreciation in value in those assets. So when you're looking at the office market, you want to be sure that you're understanding which segment of the market you're in, because you can't classify the office market with one general statement and say it's all bad or it's all good. It's a segmented market that takes much closer study and analysis in order to understand where the asset is in that market and how it's actually going to perform. So that's the summary. You can see here with our forecast going into 2025, office is first stage of recovery. So it's certainly getting out of the recession stage, and we're starting to understand what the office market looks like. It's normalizing in its new format. So stay tuned to see how the rest of the story unfolds here. So if you are considering making a change with your real estate portfolio, you have an asset that you may want to sell. We have a 4-step process that we go through here at Mansard. The first is discovery. We just ask a lot of questions. We want to learn everything we can about your plan, what you're looking to accomplish. And then what we do is we create an evaluation for you that essentially creates a market strategy for your asset to position it to our wide pool of investors. We have an extensive buyer network that we present assets to until we achieve the right price for your asset. So if that's something that you're interested in considering in 2025, we can certainly talk about that. If you do decide to engage with us, we then execute on the go-to-market plan. We market the asset until we get the right price for you. And then ultimately we get to the celebration point, which is the closing, when we get to transition and you sell your asset to a new buyer. So if you have questions about how that works, you can go to our website. It's mansardcre.com. That's mansardcre.com. And you can click on the Request a Consultation button and fill in the information, let us know what you're looking to do, or you can call our office directly at 617-674-2043. Thanks for watching. Look forward to seeing you in the next one.